Hello and welcome to the next episode of Ask the Expert Sessions. Today, we are joined by Mr. Vikram Dhawan, Head Commodities and Fund Manager, Nippon India Mutual Fund. Amid the COVID-19 fueled global turmoil, one asset class that has outshined is gold. And as a result, a lot of investors are now investing in the yellow metal. But should you be investing in gold now? In this video, we'll try decoding the reasons for this amazing run of gold, whether this run will continue, and what are the various ways through which you can invest in gold, their advantages, and what you should and an investor should opt for. So Vikram, thank you for taking out time and talking to us.
Pleasure.
Sure. So let's get started. Can you talk about the reasons behind this huge bull run that gold is seeing right now?
So one has to, appreciate the long-term, medium-term, and short-term factors which are in play, with regards to the ongoing gold bull run. So let's first consider the long-term factors which have been in the play quite some time. 20 years back, post the Asian crisis, rather the Asian currency crisis, the thought process was that since the crisis happened because the so-called tiger economies ran out of US dollar reserves. So that time the thought process was to dump everything and buy dollars. So even gold was dumped, and US dollar assets were very, very coveted. Situation became so bad that in 1999, rather in late 90s, the gold prices went to as low as 200 rounds, and the central banks had to sign an agreement, which is called the Washington Agreement, in which they limited their, to limit the sales of gold so that the price doesn't go any lower. Now, fast forward 20 years, all investors and central banks of all stripes today have realized one thing, and they're very wary about it, that whenever the US is hit by an economic crisis, the US Federal Reserve doesn't hesitate to print money and bring down the interest rates. It not only reduces the returns on the dollar assets, it also creates a lot of imbalances. So we have seen, the dollar is not as coveted or as invincible as it was maybe 20 years back. Obviously, this is a slight sentiment shift. It is still not a tectonic shift because we still don't have a substitute for dollar. But it still remains the best option or the least worst option in terms of central bank reserves. So that is one thing which is in play. And just to let you know, the 2019 rally was all about central bank buying, where there was an attempt to de-dollarize the asset to some partial extent. There was also strategic buying by countries like Russia and China, which feared that if geopolitical and trade tensions flare up, they would like to have some sort of a strategic asset in their central bank reserves. So that is one factor which is a long term, and I think it will continue. Also, we have seen in the past 4 to 5 decades structural, a trend of structural decline in the interest rates. Now, at some point of time, it was considered that deflation is because inflation is being also going down. I mean, we are living in a deflationary world for the past many decades. So at some point of time, it was considered that gold being a traditional inflation hedge, fall in interest rates or fall in inflation is bad for gold. But you have to appreciate two very understated attributes of gold. One is liquidity. It is allegedly one of the most liquid asset class. And also, the gold doesn't have any credit risk. So deflationary spirals usually come with a lot of stress on credit markets and bond markets. So you would like to hold gold, irrespective of whether there's inflation or not, just to hedge yourself against such stresses and strain developing in the market. So so also the mine supply, which has been pretty strong in the past decade because it was an overhang of the higher prices which extended till 2011, because typically it takes anywhere between 3 to 6 years for the mine to be conceived and start production. So that mine supply, to my sense, would level off. Best case scenario, it will level off, or it may even go down also. The reason is because the mining industry, not just gold mining industry, the mining industry is in a bit of a crisis because even though the interest rates are low, but still they don't have access to cheap funding, as a lot of traditional lenders into the mining industries have shrunk their balance sheets big time. And not to mention the environmental and the ESG challenges. The more the world becomes ESG compliant, the more difficulties the mineral sectors will face, especially the polluting ones. So you have to appreciate, one of the byproducts of gold mining is arsenic and cyanide, the two most lethal substances known to man. The other factor which is also contributing to the gold rally is the advent of gold funds and gold ETFs. Now, what you have to appreciate is that, by the advent of gold funds, the common grouse of the retail investor liquidity and the ease of investing, that has been sorted out. Today, you can, invest any amount of money. Rather, you can participate in the gold market with any amount of money, small or big, few grams to few kgs to few tons, with very good liquidity and a lot of ease. So I'll just give you an example. I mean, if you buy a physical bar in the market and sell it after some time, there could be an erosion of anywhere between 5 to 10%, if not more. And especially if it is a coin, you could see an erosion of anywhere between 10 to 15% or 20% because of making charges and which are a sunk cost. And also when you want to sell it, these days the investors have become very, very smart. They would ask for, a certificate and all those things. So what the gold ETF does is it, creates ease of doing investing into gold and also takes care of the liquidity.
Sure. Vikram, thank you for detailing into what's causing this rally in gold. Now let's talk about where this can go from here. Do you think this rise will continue, or we are in the last stages of this gold rush, if you have to call it?
As I mentioned, as long as the majority of the long-term factors are in play, any steep correction in gold would be a good opportunity for the investors who are looking for a long-term, participation in the gold, either from the point of view of absolute returns or from the point of view of portfolio diversification. But obviously, nothing can go up in a straight line. Gold is also vulnerable to bear markets and bull markets. The medium-term factors which may affect the gold prices would be the physical demand, as we have seen because of the COVID crisis. The physical demand in India and China, which constitute about 50% of the global jewelry demand, that has been extremely weak, all but collapsed. So we are in the month of July, we saw some of the demand coming online. So we'll have to wait and see. This festive season is coming in October. We have to wait and see. And obviously, the Chinese New Year falls early next year, February, which are traditional, buying times for both Chinese and Indian investors. So we have to wait and see that how much of that demand has been lost permanently. There could be another factor also. There could be a surprise also in the physical demand, because what we are seeing is that whilst the physical demand has all but vanished from India and China, but the Western world is buying gold in all forms, whether it is funds or physical or coins or bars. The physical demand is at all-time high in the Western world. So we don't know whether there could be a possibility that you might see the Indian investors actually trying to emulate their Western counterparts. So that is something which is a bit of a question mark, which will add to volatility in gold prices. Also, one other theme which is playing out in support of gold is, the shift in sentiment, medium-term sentiment towards US dollar. There are forecasts of dollar falling further, but I think it will be very interesting because you have to appreciate that, the two bright spots in the global economy are China and Germany, which are one of the largest exporters to US. So you could see some backlash from, in euro or yuan if dollar falls a bit too much also. It's going to be interesting times for currency markets. I'm not saying it's going to be all negative, but volatility in currency market actually leads to volatility in gold prices. Last but not the least, the short-term factor which can, lead to some money coming out of the gold market is at some point the humanity will figure out the COVID-19 vaccine, and whenever that happens, then you will see some money coming off the table. But for a long-term investor, what he or she has to appreciate that as long as the long-term trends are in play, majority of them, any steep correction would be a good opportunity to buy for for the longer term.
Sure. So Vikram, moving on to the next question. Now, legendary investor Warren Buffett, Buffett, he doesn't like gold. He said that gold has no intrinsic value and it is sitting in the bank, not earning for you. Why would people should be investing in gold? Is it just as a hedge that they should be doing, or is actually you can make some returns out of gold?
Okay. Well, with due respect to Mr. Warren Buffett, I'm also a fan. I think there's a standing joke in the gold industry, especially in India, that whenever there is an economic crisis, the Indian household, especially our better halves, who are allegedly the largest holder of gold, tend to outperform everybody, including Mr. Warren Buffett, with due respect to him. So, yes, I also, even though I've been in this business and I like gold and I've got inclination and affinity towards gold, but I think anything which doesn't pay any dividend or any interest, the fact that people are buying and placing their trust in that asset class shows that how much out of whack the financial economy and the financial, the global financial system is. How much, lack of trust has crept into investors and how they want to, diversify their risk, even though they are heavily vested and invested in the capital markets across the world. But there is a bit of mistrust. And, the history is replete with instances where things have gone wrong and gold has done better. So yes, from the point of view that it doesn't give you anything, it just lies there. But the fact that the world is, it cannot be a coincidence that 3 economic crises and people have, their faith has been, vindicated in gold. So yes, so that is why I think one cannot ignore gold, no matter what.
Sure. So we spoke about where the future is going to be. And now let's talk about options people have when it comes to investing in gold. There are a lot of options. You have, gold funds. There is sovereign gold fund, and there is digital gold, which are, I think, the top 3 and the most famous forms that people use these days. Can you talk about each of these options in terms of how they work?
Sure, absolutely. So I think every investor should have 3 buckets for gold. One is the consumption bucket, one is the investment bucket, and one is the insurance or the rainy day bucket. So with regards to the consumption bucket, it can include gold in physical form, in any physical form, jewelry, coins, small bars, or whatever, wristwatches or whatever, buy a gold phone as well. So, but you have to appreciate that whilst the feel-good factor of physical gold is much higher than seeing your gold in your Demat account, but physical gold is not a very good investment unless you are investing in a very large size. So what happens is when you're investing into physical gold, even in bars, you pay an upfront making fees, which you will never recover. And also, unless you're holding very large quantities, you will get a very, very huge spread. Not to mention the buyer today the market has become very aware. If you want to sell your gold bars in the market, the buyer would ask you for a certificate, refinery certificate of origin, and so many things. So keep the physical gold in the consumption basket. Don't mix up with your investment basket. With regards to the investment basket, obviously you can have a combination of gold ETF, gold saving funds, and sovereign gold bond. There you will have to see what kind of liquidity you want in your portfolio, because whilst gold sovereign bond are a good product, but they're still a niche product. It doesn't have patronage and participation from institutions. And till that time, there will be limited liquidity. So you'll have to worry about how liquid is your combined portfolio. Now let's talk about the insurance portfolio or the rainy day portfolio. Many people actually ignore keeping gold in that. I'll tell you why you need to keep gold in that portfolio. So you typically in a rainy day portfolio, you will have fixed deposit, insurance policy. Now, if you hold gold ETFs or gold funds in that, and God forbid there is some emergency, it starts raining, then gold ETF or gold fund will be the first one you can redeem and take money out. Insurance policy may take time. You may not want to touch your fixed deposits. There'll be a penalty on that. But if you're holding gold ETF units or gold funds, you can immediately redeem them and get the money. So I think this should be the thought process in allocating, your money towards gold.
Okay. Okay. Sure. So, expanding on that, Vikram, and one of the options which is quite famous now is digital gold. And one thing that is touted as a negative for gold funds versus digital gold is the expense ratio gold funds charge, and how it causes a big difference in returns. But is it true that digital gold you have to pay GST and not gold funds? And if yes, does the saving of that GST cover the expense ratio over a long term? If somebody goes for a gold fund versus digital gold.
Whilst digital gold is a very good innovation in the market, but I think you have to appreciate it is not under any regulatory oversight. For instance, sovereign gold bonds are under RBI oversight regulations, and we are under strict SEBI regulations. And we also have a custodian which is at arm's length from the scheme and the fund, which is separately under the purview of the SEBI. And obviously, if it is a bank, it is also under the purview of Reserve Bank of India. So there's very little which can go wrong in the structure the mutual funds provide. And whereas we have, unless we get a clarity or some regulatory of some clarity on the digital gold, and also what recourse would the investors have in case of things going wrong. For instance, in our case, the investors have recourse to SEBI. In SGB, you have recourse to RBI. So which regulator you go to? You don't want to be going to criminal lawyer, then police station just to for a financial product. So unless that regulatory issue is addressed, I would say that digital gold will always remain more of accessories to the entire market.
Okay, sure. We spoke about digital gold and gold funds. Let's talk about the sovereign gold bonds that the government offers. Is there any risk associated with them at all? Say the government changes their payout rules if the regime changes. It's a big lock-in. Do you see any risk if somebody goes for, say, sovereign gold funds bonds?
So, one of the reasons why people like to hold gold is, especially the central banks and the gold funds and the HNIs and the institutions is, and obviously the individual investor also, that gold doesn't have any sovereign or credit risk. Now, obviously, it may be a theoretical risk. We don't expect the Indian government not to honor its sovereign responsibilities. But I think that is where the difference in pricing may be observed in the market. So whilst an ETF is backed by physical gold, but sovereign gold bond will have an element of the sovereign risk. It's theoretical at this point of time, but that is actually now we are seeing in form of the premium discounts on it, and also the limited liquidity. But again, obviously you have the additional interest rate and the tax benefit in sovereign gold bonds. So it's a trade-off actually over there.
Okay. So can you expand a little on this trade-off, Vikram? Because people assume sovereign gold bonds government free, like just go and buy it. Can you just talk about the trade-off? Just you mentioned a little more.
So I feel that from the point of view it's not so much of a sovereign risk issue. Obviously, besides the pricing and besides the market discovery of the prices, it is more to do with the investment objective of each investor. For instance, if you are an investor which is looking towards gold purely from the point of view of absolute returns, then maybe you may want to allocate some money to sovereign gold bonds. But again, obviously there is a holding period, and the liquidity, as I mentioned, is limited. So you may have to be ready to hold it till maturity. Obviously, the whole purpose of buying into sovereign gold bond is to hold to maturity to get the tax benefit. If you are an investor who's looking to invest into gold from the point of view of diversification of portfolio, if you are an investor which believes in wealth creation through capital markets and also understands that to create sustainable wealth, you need to diversify your portfolio and go for asset allocations, then the gold funds, gold ETF and the gold saving funds, they give you a better trade-off vis-a-vis the liquidity. because you may want to change the allocation of each asset, including gold, and the ease and the less friction that you will have, since it is the same ecosystem. It's like a debt fund, an equity fund, and a gold fund. So the ease of it doing will far outweigh the other benefits of a sovereign gold bond.
All right, sure. Moving on to the next question, Vikram, and you mentioned about asset allocation and spoke about the three buckets. Now, how much should one's portfolio should be in gold across all these buckets? What should be that percentage be? And should one consider gold that you hold in form of jewelry as part of that asset allocation percentage that you calculate?
So as I mentioned that you should have three buckets of gold, which is the physical or the jewelry bucket is good to hold, but it should not be ideally be counted as a part of your investment portfolio.
Okay.
Now, obviously, you can broadly classify investors into gold into three categories: the tactical investor, the absolute returns investor, and the diversifier or the asset allocator. So if you're a tactical investor, then obviously, the only thing I would like to say today is that whether it is gold or any other asset class, today most of the traffic on the commodity and equity exchanges is dominated by machines that have been developed by putting in millions and millions of man hours and billions of dollars. So appreciate your odds if you're trying to make money in gold from short-term trading. If you're not prepared for it, or if you don't have the requisite skills, it's like getting up one day and trying to challenge Roger Federer for a tennis match. So you just appreciate your odds before doing that. But if you're good at it, then go for it. Now, with regards to the absolute returns investor and the diversifier, there is a bit of a paradox there. Now, the absolute returns investor is only concerned about his long-term absolute returns. He or she is maybe sector agnostic or asset class agnostic. If this type of investor is holding too much debt in his portfolio, so typically, if you see the historical returns of gold, they are somewhere between debt and equity. So, an absolute returns focused investor, if he is holding too much debt in his portfolio, then he may want to add gold to try to increase the aggregate returns on gold. Similarly, the asset allocator person, the portfolio diversifier, it works the other way around, because he's using gold to hedge the risk, to diversify the risk. So in his portfolio, the more risk assets he holds, the more he needs to allocate to gold. So first of all, you need to be very, very careful what type of investor you are and what type of investment objectives you have. Now, if you want, in terms of numbers, I will take a leaf out of the latest, analysis done by. A lot of analysis have been done in the past, but one of the recent ones was done by the World Gold Council, in which their analysis revealed that in a typical Indian portfolio, typical Indian balanced portfolio, aiming to generate in excess of 9% over longer term, if you allocate gold anywhere between 6 to 17%, it not only enhances the returns, it also increases the risk-weighted returns, i.e., it increases the volatility of returns. So yeah, 6 to 17%, you can probably narrow it down to 5 to 15%. But again, if I'm talking from the portfolio diversifier point of view, the investor who understands the value of asset allocation, in that case, the higher the risk that you are having in the portfolio. Again, measuring risk and perception of risk are two different things. So, whether you're measuring the risk by a beta or a Sharpe ratio or whatever, or your gut feel, the higher the risk, the higher the allocation. So if you're holding a portfolio which is skewed towards risk, then maybe 10 to 15 would be your range. And if you're holding, too much of high-grade debt or is skewed towards, safety, then perhaps 5 to 10% is what may work for you in the long run.
Okay, sure. So Vikram, we're on to our last question, and we spoke about asset allocation and how much you should allocate. Now, a lot of people don't have gold in their portfolios today, and looking at the returns now, everybody wants to add it. Do you think people should hold off starting to accumulate it now, even if it is for long term, or it could be a good time to even begin if for every investor?
So I think first of all, you need to appreciate that we have had three major economic crises, including this one, and in all three of them, gold has stood the test of time and has, shown its value as a hedge, a diversifier, or shock absorber, and that too in a spectacular way. So that is something which it's a kind of a track record which is very difficult to ignore. Again, there's no guarantee it will happen in the future, but it's a very very profound track record, very very hard to ignore. Also, when gold is not trying to rally, enter into explosive rallies, it is still giving you some returns. If you look at the long-term returns of gold, 50 years, 20 years, it is still decent in rupee terms, about 8 to 9% or 8 to 10%. So here is a hedge which is not a drag on your portfolio over a longer period of time, but whenever you need it, it is always there, and that in a spectacular way. So you cannot ignore gold at any price. Again, whether to buy at this level or not, it depends upon what is your investment objective. Are you buying gold purely from tactical reasons? Then perhaps you may also are looking for answer when to buy and sell gold. So I'll skip that. Are you buying gold for its long-term track record? Are you buying gold for safety? So again, as I mentioned, gold doesn't have a credit risk. So it comes in very handy when there are stress on the credit markets. Does the liquidity of the gold, attract you towards it? Because whether it was 2001, 2008 or 2020, whilst the capital markets were, hitting lower circuits and credit markets were freezing, you could still buy and sell gold. Yes, it was volatile, but you could buy and sell any amount of gold. Gold is amongst one of the most liquid asset class. It is not just the gold that you see trading on the exchange or physical market. It is a very, very deep and vibrant interbank market where the central banks are also participants. So, or you're buying gold for its inflation hedge or store of value. Now, with regards to store of value, if a gold bar, this is what every investor has noticed over the past, especially in India and in emerging markets. A gold bar the size of your cell phone, which will weigh roughly about 1.5 to 2 kgs. 10 years back, it was valued at about 30 lakhs. These kind of right spread the bets. You're putting a big chunk of money at one price at one time. You may or may not get it right. I'll just throw a statistic at a big chunk of gold in the previous peak, which occurred in September 2013, where the gold hit a high of about 35,000 rupees per 10 gram or 3,500 rupees per gram. Even then also you would have made about 6% annualized. But if you would have spread your bets over 6 to 12 months, you would have got a healthy double-digit returns. I think this is how you should approach the market. Be very, very clear why you are investing into gold. If it is a trading opportunity, then I can assure you there are a lot better trading opportunities in gold. In fact, in my past 2 decades experience, I've seen people who have bought and held on to gold have made a lot more money than those investors who have tried to trade in and trade out. And I guess that's true for every asset class.
Sure. All right. So with this, Vikram, we've come to the end of the interview. Thank you so much for taking out time and talking to us.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.